Hey, what's up guys? It's Ezekiel here. So, let me hit you with this. Most traders don't fail because they are like clueless. They fail because they they overcomplicate the whole game. They chase what? They chase green candles and then they stack indicators and then they pray that one of them hopefully would work. All it does is to bleed their account dry. Here's the truth. You don't need like 10 strategies. You don't need like 50 signals. What you need is one simple strategy that actually works. And today, I'm giving you exactly that. I call it the sweet spot. And this is the exact strategy that I use to make millions. And it's better tested with my students that is proven to kind of like cut through all the noise, right? And this locks you into high probability trades. It gives you clarity, it gives you precision and profits without all the chaos. So you don't have to like chase trades anymore. You don't have to guess trades anymore. You can forget about gambling. This is simple. This is repeatable and it works. So stick with me on this one because once you see how the sweet spot works, you never look at trading the same way again. Most traders think that trading is about, okay, I got to do more, right? It's all about doing more. I got to add this, I got to check this, I got to do that. No. The truth is that it's about doing what matters. And that's why I created this, the sweet spot. This is a simple way to lock into one high probability trade that allows you to trade with clarity. Now, before we even talk about, say, entries, like how do we enter the trade? You got to first understand the market natural flow first. Every chart, every pair, no matter what time frame it is, they all move in what? Waves of highs and low. And here's the thing, whenever say a trend line, it breaks, price doesn't just what? It sprint away from it like for good, right? No. Like a magnet, price always almost come back to retest the area that it breaks from. So that broken level is like what? It's like unfinished business. So price wants to revisit it before deciding its true direction. This is why this part is technically our what? Our map. So this is the map, right? And why is it so? Because these zones, these breaks, this retest, they show you where the money actually is, where the money hides. And these are what? Our opportunity zones, right? So think of them as what? As spots where the market, it shows you, okay, I give you a little bit of tip, okay, this is where it is, right? It tips you the hand. The trend shift, the break happens, and then suddenly you got a zone that is high probability. This is a place to stock, like a stalker, to stock your setup. Here's how it works, step by step. Okay, first, you start on a higher time frame. So let's say if you are a scalper, right? You're scalping. So your higher time frame would be what? The 15 minutes time frame, right? Or even a 1 hour time frame. So it doesn't really matter, all right? If you are a swing trader, your higher time frame can be the what? The 4 hour, the daily, or the weekly time frame. So now, as long as you are looking at the bigger picture and then you are trading in a smaller picture. After you got your time frame, you mark the trend in the higher time frame. You mark where price broke, and then you mark that retest zone. So that is what? Your destination. After seeing it on the higher time frame, where you have marked the zone, where the retest zone, where the breaking zone and the retest zone is likely going to be, then you move down the time frame. So for example, if your higher time frame is a 15 minute time frame, you can move it down to the 1 minute time frame and let the market prove it that it can take the move back to that level itself. Now here's the thing, when price finally breaks back to that zone, that is not your entry. All right, most people think, oh, it reaches the zone, that is my entry. No. That is your map, right? You don't jump right in because it touched. Because 9 out of 10 times, the market will revisit that area before showing its hand. And that's where most traders, they get it wrong, right? They dive in too early. So no, you don't just dive in, you wait. Timing is everything. All right, so now you got your map. You have marked the breaking level. You spotted the retest zone. Now here's the golden rule. The map shows you where, not when. Timing is everything. The way we nail timing is by what? Waiting for the trigger. Alright, right? So now,
What is the trigger, Ezekiel? This is a simple and it's a repeatable confirmation that tells you that the market is ready.
so in my framework, that starts with what? Spotting the, in this case, the lower high itself. In an uptrend, it will be what? The higher low itself. And then waiting for the true break. So most traders, they see price touch the zone, they dive in. No. What you need is proof, right? So we want to make it even sharper. Price action gives us two major signals. First one is what? The break of structure, which means that what? The market, after making a higher highs, there is a break of structure, right? Is continuing in the same trend. The other one is change of character. That's where the market shift the direction. So now from a higher high, and then now it starts to make lower high. When you're hunting your entry, you are waiting for what? The change of character. So let's say the downtrend keeps making what? Lower highs, lower lows. And then suddenly price fails to make a new low. And instead, it pushes above the previous high. So that is a change of character. That is the first heartbeat of a reversal. So now here's one more thing to make it deadly accurate: the fair value gap. Think of the fair value gap as the market leaving footprints in your chart itself. So technically, the fair value gap is when you spot, say, 1, 2, or 3 candles moving in the same direction, whether they are bullish or bearish direction, and you notice that the wick of the very first candle high doesn't overlap with the wick of the third candle low. What you get is a clean, untouched box area that is left behind on the chart itself. Okay, here's the thing. In actual fact, fair value gap can be a little confusing with all the definitions. And sometimes the definitions, the theory are not pinpoint perfect. So the key is to what? Is to see a good size in the uptrend, a good size bullish green bullish bar, right? That kind of what? Start from the middle area. So the opening is around the middle area of that consolidation, that consolidation. It doesn't open near the top, it's kind of open near the middle, and then it closes cleanly. It's a big bar. It closes cleanly, so there's not much of a wick at the top. It closes cleanly, so it's not a wick such as there's a top wick and it doesn't become a bullish bar. So just, it can be a little bit of wick, it can be no wick, it's a good long bullish bar, and that closes what? Above the bodies. Not necessarily the wick of the previous high, it can be above the bodies of the previous highs bars around the left hand side. So that itself would be considered a good fair value gap. Now that you have lined it out all up, quick pause. If you found this video helpful so far, here's something that always surprises me. 73% of you who watches this video regularly haven't subscribed yet. If you're getting value and want to support what we are doing, the best way is just to hit that subscribe button. It's free and really helps us to continue creating better content for you every single week. It truly means a whole lot to us. Okay, now let's get back to it. You got your map, alright? Recap, you got your map, you got the retest zone. So then you see what? So for example, let's say downtrend, right? And all of a sudden, trend line, for example. Then after it broke through the trend line, you got your retest zone, right? Then you see a change of character. Downtrend, change uptrend, break of a higher highs, break of the lower highs, all of a sudden you break the highs. Then what? Then you spot a fair value gap forming. So all this stacks up. And when that happens, that is your sniper shot. That is your sweet spot of entry. And that is your high probability area that you got to go in. Now it's time to execute the trade. So the cleanest way to do it is to enter where? Right at the break line. But of course, make sure that the break is true, right? It's a real line. It's a real breaking level. You put your stop loss below the structure and then target the retest zone that you mapped earlier. You may say, okay, what if I miss it? That's trading.
Ezekiel, what if I miss the trade? I'm not always there at the market itself. What if I miss the trade?
That's normal, right? The market will always give you a second chance, another chance. There's always opportunities like that coming along. So the key is not chasing it when the market is taking off and then you start chasing it. Oh,
I better get in right now because Ezekiel said this is a good trade, but I missed the entry point. I better get in right now.
No. When it's gone, it's gone. You wait for the next trigger. Because why? And here's the thing you got to take note. One perfect entry would beat 10 random ones. You got the trigger. The next question is, now I'm in the trade. How do I actually milk the trade for all it's worth? And that's where we move into the final piece, the money machine. Technically, this is where the framework, where it turns good entries into consistent profits. So the first rule of the money machine is that your stop loss is like a sacred area. It's a very, very important area. And always place it just beyond the structure itself. Because the structure is the proof. If price breaks back and beyond it, the market has spoken that your trade idea is wrong, and you respect that. That small, it's not very big, right? That small controlled stop loss keeps you in the game to hit your next sweet spot. It keeps you in the game in the long run and always there ready to take on the next sweet spot. So now the next thing, asymmetric risk. Forget about being right every single time. You know, most traders, they harp on that, right? Oh man, I make a loss again. Oh no, I'm wrong again. Oh no, I'm wrong again. No. Forget about being right every single time. You don't need to. One good winner, based on our trade setup, should pay for 5 small losses. And that's the game. So for example, we aim for what? At least 1:3 or 1:4 risk to reward ratio. So for example, if you risk $100, you aim for $400, something like that. So that way, even if you are wrong 3 times in a row, one win covers it all. And more, once price reaches and hits your first target, which is usually the retest zone that you have mapped earlier. Okay, now you got a choice. Do you take all profit or do you let it run? So here's the smart move. Scale out. Close part of the position to lock in profits, and then you let the rest ride. Right, so that way you get paid no matter what. You also give the trade room to turn into something massive. This is where trade management becomes an art. You can trail your stop, move it just below each lower high or lower low itself if you are going long. This way you are protecting your profits, right? So giving the trade enough oxygen to grow. So if the trend keeps running, you ride the wave. If it snaps back, you walk away, still being in the green itself. Say you risk $500, you catch a sweet spot, you enter and price rockets, and then you trail smartly. So by the time you are out, for example, you have made say $3,800 from your $500 of risk. That is a 7.5 risk to reward ratio trade. So remember, just one sweet spot entry like this can, for example, make 7.5 risk to reward ratio. That is enough to cover all the multiple small losses and allow you to stay consistently profitable. Now, here's the beauty. You can afford to be wrong 5, 6, 7 times after which and still be up even big time. And that is how consistency is built. So here's the secret that most traders, they never get, okay? Sometimes the best trade is no trade. If your setup does not hit all 3 pieces, the map, the trigger, and the money management, skip it. Because one clean, high probability trade, like I said, can pay more than 10 random steps in the market itself. Even with, say, you only got a 50% win rate, consistent application of this setup is going to give you a real positive result. Not just positive, like big results over time itself. So the money machine is not about gambling or is it luck. It's about creating a repeatable system. Small risks, big winners. Lose small, win big. And that is our mantra. Good? Okay, so here's what to do next. I want to give you something that's going to change the way that you trade forever. So I've put together a free training that walks you through the exact 3-step system that I use to find high probability trades with sniper level entries, real risk control, and zero guesswork. So this is the same system that I use myself, and the same one that has helped thousands of traders go from frustration to consistent wins. And I'm giving it to you for free, right? There's no fluff, no fueler, just pure strategy. So if you ever wanted to trade with clarity and real conviction, this is the place to start. So click on the link in the description below and I'll see you inside the training.